Hi, everyone. Welcome to the final episode of Talking Deals with David for 2024. We've got a very good crowd, I think, signed up for this one, where we're going to do a pretty deep, advanced dive into representations and warranties, insurance policies. Um, I think I promised a lot. Jennifer, Peter, thanks for joining me today. I think it's going to be a fun discussion. I appreciate you taking time out of your day to join me.
Yeah, thank you. Thank you for having us.
Yeah,
Yeah,
great.
back, David. Thank you.
Yeah, no, you're welcome. Yeah, you saw some of the posts I was doing about this. I know we both, all of us, have done, I think, some presentations. I know Jennifer, you and I have done a few um, at our firm, for example, on RWI and really getting into the basics about these policies, how they work in deals, and talked a little bit about some of the issues that you may run into when you're thinking about bringing RWI into a transaction. Um, but I don't think, at least I haven't really done more of that deeper dive with the assumption that folks now are very familiar with the product, how it generally works. But what are some of the gaps, some of the more difficult areas that you run into when you're putting an RWI policy in place? And so I thought it would be terrific to have both of you. Jennifer, of course, a partner of mine at K&L Gates, and we work together on deals a lot in the RWI space. And Peter, you're a broker, but also have experience, I think, as a lawyer and also an underwriter. So maybe just give it a second on kind of your background, which I think is interesting.
Yeah, I would love to, and really appreciate the opportunity to be on here with you both today. Yeah, my background, I got out of law school in 2004 and practiced law for 11 years. And my last year as a lawyer was in 2015, and I was the RWI specialist at Ropes and Gray. So spent all my time negotiating the terms and conditions of reps and warranties policies. And that's right when the product was taking off. And, essentially private equity sellers realized that they could get a full walk away, and it was a seller favorable market and required buyers to buy it. And just the product took off like wildfire. Then went over to AIG and spent 3.5 years underwriting reps policies, underwrote about 150 policies, and got good insight into how insurers are thinking about the product. And I think it's important, actually, when we're talking about it, is kind of keep in mind what are insurers thinking, right? Because it's not an us versus them. I think in this game, this is a cooperation and a partnership between buyers and sellers. But now over into the broker side for the last 5 years. So spent 9 years really only in the reps and warranty insurance space, and really have nothing but great things to say about the industry. There's so much talent in the industry. And it's really, pretty remarkable when you think about it, what reps and warranties insurers are able to do. I mean, insurers are notorious for being sort of slow to innovate, but the fact that they're able to come in on a bespoke deal on very short timeline, have a perfect track record with confidential information, and come in and do a bespoke policy on a risk that's fast moving, and then have a great track record of paying claims. I mean, North America, we have more than 2 billion of claims having been paid. So it's a pretty phenomenal success story. So I know today let's talk about how we can do even better, but I would think we should start from a baseline of this is already a great product.
Yeah, it's certainly, I mean, certainly the growth that I've seen even, in the last 10, 15 years has been really incredible. And, I've often talked about that. It's a industry that's very responsive to the needs, I think, of people like me on the deal side. But it's not a perfect solution. And when you're doing deals and you're trying to allocate risk, you really need to have a good understanding, I think, which is why I want to do this a little deeper dive of, where it's good, where it works, and areas where you may have gaps or that you don't have perhaps great coverage. And, again, as a deal lawyer, then you have to think about how do I use other tools in my toolbox, whether that's some kind of more traditional seller indemnity, or whether it's just some upfront negotiation over valuation. But there's different, levers that you can pull. But first, you need to understand that. So, Jennifer, one of the things that I always preach, and I think you would agree with, is you can't relegate RWI to sort of toward the back end. I think if you're a deal lawyer, you have to be thinking about that, whether you're on the sell side or more particularly on the buy side, from the very beginning, because you have to anticipate, how that product is going to come into a deal, what the staging may be, and also have some of these negotiating fallback positions so that you're not kind of caught off guard if it turns out that there are certain exclusions or other things that you run into when you're placing the RWI policy. But I want to get a feel from you, Jennifer, because you have a great background. I know you love insurance. You started as really an insurance lawyer and have taken that expertise to kind of come over a little bit into my world, the world of sort of the deal lawyer, and have done a fantastic job. And so we work together on deals really from the beginning. But what do you think about when you first get a call from someone like me and you start thinking about a deal and putting a policy in place, or even looking at a first draft of a policy? What are the kind of things that come into your mind that you want to be sensitive to, especially from obviously the buy side?
Yeah, so I think, to your point, over the last several years, practitioners, attorneys they've become more accepting that insurance is just going to be a part of the deal. At first there was a reluctance. Do I really have to use this product? And they would kind of negotiate hold on till the end. And then, okay, well, let's go to the market and let's get this product. And then sometimes you'd have to, with like an afterthought almost. And so now I think attorneys are much more proactive and involving me or other insurance attorneys at other firms earlier on in the process to think through from a holistic level of, what is it that we need to think about? When we go to the market and get quotes, for instance, is kind of the starting place. What are some sensitive points here that we should bring up and preview with the market and have them factor that in and understand how they would handle that in underwriting? So I think that's, starting even at that stage is important. But then even, beyond that, some deals are pretty routine. I say routine, I guess they all have their quirks. But you want to examine the NBILs, the non-binding indication letters or quotes, and make sure you understand what the terms are and compare the offerings from all of the markets that are quoting. The brokers, Peter, you all do a fabulous job of this, are really good about highlighting the differences among the quotes and providing these summaries and helping the insureds and counsel understand really what they're getting. So I think those are two important points on the insurance side. And of course,
yeah, and if I maybe just to jump in on that, because I think there's a lot to talk about on those before you go on to others. But I do think that the insurance selection might be the most important part of the placement process, and I think also it's great to, what the brokers do and what we do is come and give recommendations. But I think having a conversation with the client as to what is the client's real goal, what are they looking for, and what are their priorities? Because there's now a very robust insurance market with over 29 insurers, but all the insurers aren't fungible. They're not the same. There's significant differences, particularly among underwriting appetite. So some insurers may like certain deals better than others. And so you want to have a good fit so that you're not going to later on have an insurer that doesn't really like this risk and is going to try and take exclusions. But what are things that are important to your client? Does your client have a strong underlying relationship with a specific insurer and been working with a specific insurer, and so maybe you want to keep business with them to build up that relationship? Or are they very price sensitive? Are they very focused on the coverage, or are they very, very concerned about whether the claim will get paid and will it be a smooth process, right? And so you can sort of prioritize those things when you're comparing the insurers, right? You can, of course, just compare based on pricing, but you can also compare on any other number of topics. And getting the insurers to be really thinking about that are important. And I do think that if you think about the RWI placement in a two-phase process, right? The first phase is you're going out to all the markets to get quotes, and then the second phase is you let the one selected insurer behind the curtain and into the underwriting process. Prioritizing as much as possible in that first phase can be really helpful. And I think the point you're making about the NBIL is a really important one. I think, we could talk for a while about what to look for in that NBIL, but that can be, I think, and I'm sure, Jennifer, when you look at those can be fairly negotiated. And sorry to use the jargon, but the NBIL, for folks who don't know, just means the quote letter that you get from the insurer.
And you're seeing more of these, right, Peter? Because you mentioned the market. So, I remember when I started doing these, maybe late 2000s, you might only get, 2 or 3 insurers, right? The market wasn't that saturated. Now you mentioned, I think you said 29. I thought it was 26, but whatever it is, it's near 30 different insurers. Now, everyone might not be right for, any particular deal, but you're going to get back on, a normal deal that, that presumably has interest from the insurers, quite a few, favorable responses. And then I think, Peter, what you do, and I know, Jennifer, you and I do this, and you do great work on this, typically you'll put together a grid, right, that'll kind of lay out all the different insurers that are interested in underwriting. And then it will kind of give some sense about exclusions, cost, obviously, if there's any particular underwriting, requirements that they need. And you can see differences start to develop in those. But really going through and having experts like you, Peter and Jennifer, to kind of work with you on the deal team side to think about what is the best policy, what's going to have the best underwriting team, who can move quickly, what's the cost structure. And it's not always the case, obviously, that you want to go to the, clients may want to tend to look at that, like what is the lowest, cost, but oftentimes you want to find the right mix where it's a balance with the cost and what the coverage are and what the underwriting requirements. But how significant is the underwriting team? The people at the insurance side, I know they're made up with a lot of people that have deal experience, insurance experience. Does that make a difference in the time of placement and also the ability to kind of negotiate policy language with the insurers?
In my experience, it absolutely does. And, Peter can probably speak more to this, but when you have a transaction on a tight timeline, you might consider certain underwriters as superior to other underwriters. Or if you have, if you're trying to place coverage and need a tower of insurance, so you need to, you have a larger policy limit, that type of structure may lend itself to certain underwriters. So there are certainly considerations like that and reasons to that you might use, even like non-substantive. I mean, certainly, as Peter mentioned, there are some underwriters who are just not interested in underwriting certain types of deals or certain sectors. But even beyond that, there are considerations in the underwriting.
Well, Jennifer, what do you focus on? Because one thing I mentioned was negotiating. I think there's still people that don't realize that in some ways this is kind of a bespoke, product. Of course, over time there's consistency, and if you looked at different policies, you'd see broad similarities in terms of what the scope of coverage is, and even what the policy language is to some extent. But it's not the same as your car insurance policy, let's say, that also provides indemnity coverages, right? That are much more a formulaic kind of approach, and you're not going to call up and typically start negotiating language. But these policies in many ways are bespoke, and they can be negotiated and are negotiated. You don't just necessarily have to take the initial language that's given. What kind of provisions, Jennifer, do you sort of focus on and suggest clients focus on when you're thinking about, okay, how do I review this policy I'm looking at? What kind of things am I going to kind of pay particular attention to when I'm thinking about negotiating the policy language?
Yeah, so that's a good question. I mean, you're right. So the policies themselves are they're not a form. There's not like an approved form for certain states how that works in other markets. So here, as it's evolved, there are the policies all typically work the same way. The language is different. The provisions may be structured a little bit differently, but you've got the same key terms, and those remain relevant and important from underwriter to underwriter. So, for instance, you're going to pay very careful attention to the knowledge definition, for instance, the breach definition, the loss definition, and exclusions. I mean, those are all very critical things to look at, and will pretty much align from policy to policy. So I would say to start, you're going to start there, but you also want to make sure that the policy works with your underlying transaction agreement. So, you've got to have somebody that's looking, are we referencing the correct fundamental representations, defining the correct representations as fundamental in the policy? Are we even making sure that the definition of breach references where the reps and warranties are in the underlying transaction agreement? So you've got to make sure that the policy works
keep up with those over time, right? Like Peter, I think when we had a call before, just kind of kicking around this idea, I think we were talking about that, right? That you have to have somebody that's really attentive and responsible, that knows how the deal is evolving, and then is able to kind of pick up along the way. Like Jennifer, I know that you and I have run into deals. You can see exclusions pop up toward the very end of the process. Maybe you can get a conditional exclusion, maybe you can deal with other things, but if you're not tracking that on the deal team, you may miss the opportunity to go back to the seller and look for some kind of a standalone indemnity or some other mechanism. So you have to track that. Peter, do you run into that too, of making sure that you're kind of tracking as the deal goes? And we all know how the time, frame on these deals. Sometimes it's overnight, you're getting turns of these policies, but tracking that and sort of the administrative piece of it really does make a difference pre-closing, but then also after closing when you're monitoring things that may come up after closing.
Yeah, no, I think that's a great point, and that's why this is such a labor-intensive effort. Is that you are in real time. The policy is tracking to a live document, and so I think the tendency is to say, oh, well, we've reviewed this policy and it's a good policy. We're happy with it. We're signed off, but the deal isn't signed yet, and then terms of the agreement continue moving. Definitions move, and those definitions are tied to exclusions potentially, right? You could have an exclusion in your policy for defined terms, specified matters. New things are being added to specified matters as the deal goes on. All of a sudden, your policy is getting narrower, and no one's really paying attention to that. So that's one element. But also the flip side of it on the timing process is also one other challenge, and a frequent kind of complaint we get about the process is that often the draft policy is not provided until after the underwriting call. And sometimes on a very condensed time frame, you may have an underwriting call and then have signing only a day or two later. So is anyone really going to have time to do the tedious task of checking all the section references and really closely reviewing a policy? That can be harder. So one good tip is, can we see if we can get the policy drafted a day or two ahead of time, or even 2 or 3 days ahead of time, based on a recent precedent. The other thing, of course, is can we work with a precedent form, right? Because theoretically, you can negotiate every single word in an RWI policy. It's a bespoke policy, but as a practical matter, it's a very bad idea to do that, right? You probably, if you're negotiating the policy, you're going to want to focus on maybe 5 or 10 key things. The underwriters are very, very busy. They don't have time to be, extensive negotiations every time they do a policy. They're going to start from a very good place from your precedent policy, but doing too much can also be detrimental. But I think there's having additional time to look at the policy, but then just making sure that we're ticking and tying to terms of the agreement during the entirety of the process can be really helpful. The other process point that I've found tricky is conditional exclusions. So sometimes you'll run into a situation where you don't have time to finish your diligence and signing is coming, and the insurer will effectively give you an accommodation and say, you don't have to finish before signing, you can finish after signing, and then we'll retroactively remove the exclusion, assuming that the diligence comes back clean. Well, that's a nice accommodation. The problem is, in my experience, a lot of times when a deal signs, everybody then just puts their pen down and goes on to other things, and it's hard to then focus people. Don't forget, we still have to finish this diligence item, and then all of a sudden days become weeks, and when are we ever going to get back, and who's tracking this, and everybody's moved on to other things, and that can be another process challenge.
Yeah, you really have to do that. I mean, Jennifer, you and I have, we've had to chase folks on doing conditional exclusions, which again is a good way if you're getting an exclusion that you could deal with maybe some more diligence, maybe digging a little bit more. That's one of those where the insurance companies, I think, have been very responsive and allow you to sort of clear that after closing, so you don't have to hold up the deal. But assuming you can get the diligence in, as Peter said, they'll remove that exclusion. We are getting a couple questions. I'll just answer the first one. What point would RWI be purchased? Is it purchased specifically for one deal? Well, yeah, it's a deal by deal specific kind of policy, right? So it's not one policy that you'd get in place, for multiple deals. And usually most deals we run into these days, although there is seller policies that you can get and that were more common, I think, a long time ago, most of these are buyer side policies, right? So the buyer, at least in the US, will kind of run the process of the RWI, and the seller in many ways is kind of just sitting back, watching that process. Their concern is mainly just get it done, right? So it doesn't affect their deal timeline. And John, thanks for the comment. John's watching while enjoying a peanut butter and jelly sandwich, which is a terrific way to learn about advanced RWI topics.
Yeah.
But David, if I could just chime in quickly on
Yeah,
the first question, which I think is it's actually a very important point, that this is a one-off policy on a one-off transaction, and so you could, and that's what's actually remarkable about the reps and warranties industry, is that you could think about this as a zero-sum short-term trade. You have one deal and one deal only, and you're doing a trade with the insurer, and you should try to get your absolute best out of it, and they're also doing the exact same, and there's no cooperation, no long-term partnership, and that could be how both sides approach RWI. But in practice, and in my, I've been doing this 9 years, that's actually not how it's done. It's actually done as a long-term partnership where insurers are thinking, we're going to have multiple deals, maybe not necessarily with this buyer, but with that buyer's counsel and with other counterparties, that broker. And we're trying, just as this, when you buy a D&O, you may every year you renew, and so you can have a long-term relationship with an insurer. And so I think, and that's actually the reason I think this industry is successful, is when we start seeing long-term partnerships and long-term thinking, as opposed to zero sum, the reps insurer is my adversary. I think that's the real challenge, is when you start viewing the insurer as the adversary as opposed to the partner. And that's actually, if you think about it, just theoretically, one of the big differences with a traditional indemnity, right? Just by its very nature, if you're making an indemnity claim against the seller, it's because there's been some sort of breach in the relationship with the seller. The seller didn't do something, they misrepresented something, you're bringing a claim. If you bring a claim under a reps policy, there is not a breach. That's part of the mutually beneficial relationship. It's not adversarial. This is what you signed up for. I'm not saying you can't ever have a dispute with an insurer, but I'm saying when you bring a claim, that's part of what the entire relationship is. Getting claims.
Well, Peter, that's a very optimistic, in my mind, overly
optimistic. Of course, there are disputes with insurers, right? So I'm not saying you can't have a dispute, but I'm just saying the fact of making a claim is not itself a breach of the relationship.
Yeah. Well, and how insurers do respond to claims, Jennifer, I know that's one thing I always hammer you about, and we always talk about. I haven't found it necessarily to be a pleasant experience when you make a claim, and insurance companies will typically do, their kind of normal reserve rights, and it's an insurance company, so they respond in the way that you often expect insurance companies to do. But there are differences, of course, and knowing how the insurers will respond to claims, and their skill at doing so and timeliness at doing so is part of what we think about, right, when we're advising clients as to which underwriter, which insurance, policies make the most sense, right, in terms of thinking about what will happen if there are claims.
Absolutely. And, as Peter mentioned, we have a good claims paying history generally in this market. And so that's been great. But you're right. There's also how quickly will a certain underwriter respond? Have there been any past issues with this underwriter? So you have to take all of that into the big picture into account when you're advising a client on which underwriter to select. In my experience, the claims process is a lot less painful in the reps and warranties area. I know, David, you find it very painful still, but that's because you don't do a lot of other insurance work, or any really. So
that's true.
No frame of reference, but this has been a lot more pleasant. The counsel and the consultants and the parties on the other side are really make it a better process than what you typically see.
Well, let me draw one distinction that I do see. I've written about this, and I know, Jennifer, you kind of know my view. When RWI came out, I was very opposed to it. I was a late adopter. I thought it was way too expensive. Coverage gaps were way too significant, and it just didn't work well. And most clients of mine, corporate clients, agreed. They just weren't adopting it, and many still don't really like the product. But over time, of course, that changed. And Peter, you mentioned some of the reasons why. The industry has really brought on a lot of experts in deals. They've been very responsive, and so and much more competition, which may be the most important factor. So more competition, obviously driving more innovations in the product. So that's changed. So I don't have that same view, and obviously in almost every deal I work on, RWI has got to find its way somewhere. So it makes a lot of sense. Where you have uncertainty about a position, so there's maybe a little uncertainty as to whether or not there's a loss and whether or not it meets a breach of a rep or an inaccuracy of a rep. I find that having a healthy escrow and a more traditional indemnity structure is a little easier to navigate, because there it's relatively easy as a buyer to freeze that escrow, and then it just stays almost in perpetuity until that's resolved. And there's a real incentive, even in cases where there's good arguments on both sides, to resolve it. I found in somewhat similar circumstances, again anecdotally, that it's much more challenging to resolve that with an insurance company, where they're holding all of the money at that point. There is no escrow. There is nothing that kind of can be frozen, and so you're in a much more difficult situation. But I don't know how either of you have dealt with that on more clear cut cases, where it's pretty obvious that there's coverage, and and there's been an inaccuracy. I agree, Jennifer. It seems like they pay promptly. That's a relatively cooperative process, and that helps a lot to make it a more valuable product.
Yeah, I mean, it's a business. They're in it to. There are some differences that the seller versus the insurer, and the way that they look at a claim, but you still are going to have to prove a loss and a breach, and you're going to be put through your paces to provide the information and help bridge the gap of understanding between the buyer and the insurer. But you're right. I mean, I think there are some differences that make the process different, or make the considerations different from an insurer deciding to pay versus the seller deciding to compromise and release some escrow and moving on.
Yeah, well, that's where advanced planning, I think, to me, really is important from the deal side, because, and this is why I think this discussion with both of you is so important, because thinking through what you're going to anticipate and see as that negotiation develops and you're placing an RWI policy is really important, because you need to make sure that you've positioned yourself in a way that you're able to get some kind of standalone indemnity from a seller if possible. Or if that's not possible, you'll have to find some other ways to deal with risks that might be excluded or not otherwise covered. One thing I wanted to talk about is interim breach. That's been an issue, Jennifer. I know I also complained to you a lot about that. But as deal timelines have gotten longer, and we're seeing much longer periods between signing and closing, as the market has sort of been in a bit of turmoil. Hopefully, we'll see those closing periods wind down. I've always had a concern about interim breach, which are breaches that occur after signing but before closing, and that about in that interim period. Hopefully, I just described that right. What are you thinking about that, Jennifer, and then Peter? I know there's some coverages now that you can add on to the base RWI policy to get some expanded coverage for that period. But if, as you're looking at a 6-month, 9-month, even a year process, in some cases where there might be regulatory approvals, you've got a big gap where lots of things can and do happen that can significantly impact the value of the deal. And so how has insurance been dealing with that interim breach issue, Jennifer?
Well, I think, one of the keys is making the definition of interim breach as tight as you possibly can. And I think you just said it well. You want the breach to have occurred during that period between signing and closing. I know some policies and some underwriters will want to define it as facts and circumstance. The key facts happened in the interim period, the period between signing and closing. And so just really tightening that up is really important. But it is, I mean, it's still, it remains a problem. I have, the products are out there, products and coverages are available, as you mentioned, but there's still, I don't know that clients are really, I haven't had clients really pursue that, or I guess many clients pursue it, I should say it that way. So I'd be interested to hear from Peter how many of those types of policies he actually sees placed on a routine basis.
Yeah, and I mean, I think so. You were correctly described the interim breach exclusion, which, by the way, is maybe one of the big differences between a traditional indemnity and a reps and warranties insurance policy, is that the insurance policy would have this interim breach exclusion between for breaches first occurring between signing and closing and discovered between signing and closing. I guess my kind of glib first response is that I've actually never seen a true interim breach. I've seen lots of things that people think were interim breaches, but turned out to be breaches of signing reps, right? Because you actually have to have the thing that causes the breach to occur after signing. You can't, a litigation filed after signing that alleges things that happened pre-signing is not an interim breach. That's a breach of a signing rep, and that's fully covered. So it's a fairly narrow set of circumstances that would have to occur. Some completely new event, like maybe an earthquake that occurs post-signing, that would be excluded. And just also just some understand why do we even have this, right? Because how does an insurer get comfortable? Because that's you think about it, it's kind of crazy. I mean, you could do a thought experiment and say, would you want to be a reps insurer? Would you want to guarantee the accuracy of the financials of a company, guarantee compliance with all laws and, all these other reps? And would you want to do that for, 3% of the amount of your policy? Would you take that bet yourself? Would you want to be a reps insurer? I mean, they're taking on a lot of risk. All right. And how do they get comfortable? Well, it's because of the buy side diligence, right? And then the seller's disclosure process. But during the interim period, there is no diligence and there is no disclosures, right? Because everything is fixed in time as of signing. We're not continuing the diligence post signing, and the disclosures are fixed as of signing in most cases. So that's why there's also a moral hazard issue as well. If a seller knows that there's coverage for interim breaches, they can start operating the business differently. So that's the challenge, right? And you don't see that with the traditional indemnity because they'd be on the hook if they started doing that. So that's really the challenge the insurance industry has been trying to fix. To their credit, they have come up with solutions. The solutions somewhat limited generally, and there hasn't been a tremendous uptake. I think really the reason for that is you typically have to pay more money to get the interim breach coverage, and most people haven't really seen a lot of examples of true interim breaches.
Or they've seen them but they don't think about them in advance. I mean, I've run in, and it's also an example where you really have to tailor the language from the deal side to what you both do on the RWI side. You could have situations where you have an interim breach, let's say, but you have a very high closing condition standard, and so you're not able to exit the deal or leverage the ability to exit the deal as a way of getting coverage from the seller directly for that. Meanwhile, you have a very significant potential loss, although it may not rise to, like I said, if it's a high closing standard, like a material adverse effects or closing standard. So as a buyer, you can be really boxed in. You can have this loss that may not be covered, but you have weak, if maybe no ability to exit the deal. So your ability to negotiate with the seller has been difficult. I've had a couple of those situations where we were able to negotiate some special indemnity, some special coverage with the seller, and keep the deal going forward. I've even thought about drafting initially a concept that if there are some of these interim breaches, that in effect that becomes an indemnity item, but I've never actually pushed that forward enough to see whether that might work or not. But thinking about those areas again, to me, makes sense, because you want to at least be very aware of where you do have coverage and where you don't. And whenever I brought up interim coverage with a buyer, most of the time, even very sophisticated ones, they have no idea what I'm talking about. And Jennifer, what you said is very important. The language is very different sometimes. And I know you're very careful at marking up the definition of what that means, so that it really does pick up, Peter, the example you gave, so that if you have things that are happening in both periods, it's clear what is and what isn't an interim breach, and trying to make that more narrow. And I think, Jennifer, you've had good luck doing that, right? I think the insurers are typically responsive to that when you work to clarify that language.
Oh yeah, absolutely. They're typically, and there are some that don't give you exactly what you want, but they understand the issue and are trying to cooperate to minimize the issues that they're concerned about, which is what Peter discussed, versus giving the buyer fulsome coverage. And I think that it's just that the market is very responsive to most issues that come up during deals, and are really good about understanding how to fix them or bridge the gap.
Well, one of the questions I got before the show was a couple, actually. We're talking about these cross-border deals. A lot of people were interested in that. Peter, I know you and I have talked about that a little bit, and you mentioned some things about that. I think there's different perceptions on that, but it's a different market, right? In some ways, it's a bit more evolved in Europe. I've always found that the pricing, I don't know if that's still the case as the U.S. pricing has gone down, but it's a little less expensive for policies in Europe, but a little bit less coverage. It obviously tracks the way deals are done. What do you see, Peter, in terms of cross-border deals, and are there some more hybrid policies that are kind of U.S. style, especially for U.S. buyers that want to have more of a U.S. style approach in a cross-border deal? Can you do that? And are insurers now, being more receptive to that?
Yeah, no, absolutely. And yeah, you hit the nail on the head. I think, at least if we're going to overly generalize, uh, RWI in the US is more expensive but gets better, broader coverage than what they call RWI in Europe, which is W&I, confusingly, because apparently they don't have representations, or
Right.
very rarely do they. So they call it warranty and indemnity. So confusing jargon there. But W&I, less expensive, but often, insurers quicker to take an exclusion, quicker to modify the reps, or what they call the warranties. And so they have a warranty spreadsheet. And so more of like an opt-in as opposed to opt-out of, here are the warranties we're going to cover, as opposed to in RWI where here's the reps we won't cover. And so kind of a different approach to that. But a lot of the RWI insurers have teams on both sides of the ocean, and constantly doing global meetups and Zooms. And so they're very, very, there's a lot of convergence, I guess, is the point. I mean, you're not going to change the fact that M&A is done differently in Europe than it is in the US. And that's why you have differences, right? The RWI is flowing from there. For example, data room disclosed in Europe. And that's why you're getting an RW or a W&I policy that's going to say, well, if it's in the data room, it's not covered under our policy. Whereas in the US, we wouldn't have it. But I think you're right also that really what we need to do is set expectations for the client. So just as an example, we recently had a US buyer buying a French soccer team. Now just think about the complexity of that, right? It was a US deal, but the French soccer team, and so but the loss and the potential of loss is all of these compliance with French laws. So if you're going to try and work with a client, you're going to want to have them working with an insurer who speaks their language both literally and figuratively, right? A type of policy form they're comfortable with, a precedent form where they, and everything's familiar. But on the challenge is you don't want an American underwriting French law, right? What the role of an underwriter is essentially to intelligently accept risk. It's to say yes to risk. And if you don't understand a risk, you can't do that. And it's very hard. If you asked me to underwrite French labor law, I would say no, thank you. That's all I know, is that it's really scary. And I think that's probably what Americans will think. So you need to have a French person to underwrite it. And so when we did that deal, we had folks who had both in the US and in France, right? So the French people could say, yeah, these labor laws are not scary. And although you might have thought you should take an exclusion, we're going to get comfortable. And that's what really good underwriting is. It's cutting the wheat from the chaff and saying, yeah, we can actually take this exclusion. We don't need this exclusion. We can live with that risk. And that's how you're getting to differentiate insurers. Going back to your initial question, what's the difference between the insurers? Some insurers have more appetite for some risks than others. It's also underwriting expertise. So they understand the risk. So having local expertise can allow you to get a much broader coverage than an insurer who's just going to kind of knee-jerk have to take broad exclusions because they don't really understand the market in which the deal is happening.
Yeah, it's true. Jennifer, what's been your experience about that? And are you seeing in Europe, are they still doing more stapled policies where you get like the seller kind of packaging the RWI policy for buyers? I've run into that much more frequently in Europe. I don't think I've ever seen it in the US. I guess you could do it in the US, but it doesn't seem like that's a normal way to do deals here.
Yeah. So typically, I mean, I think that's definitely true, and that's I've seen that as well. But I do typically, if I'm in a transaction and it, we've decided, so sometimes we try to get RWI, and the market responds and says, this is really, this is European.
Mhm.
You need a W&I policy. We have, we have counsel in Europe who reviews those policies. So I tend not to get as involved, just enough to know the key differences and usually work with you to try to urge us to try to get the RWI US style versus the W&I, but then I turn it over. So
right. And do you normally have, I think you've told me this, I've always kept it in my mind, but you generally have to have US law governing, just as an initial gating item to kind of, even if it's a cross-border deal where, let's say, a US buyer is buying assets in Europe or other places around the world. If you have US law governing the agreement, does that make it a little bit easier to get the US style policy?
that's one consideration. it also, they're going to look at other things like is the named insured a U.S. entity? So that's going to be pretty
Yeah,
important.
that's right. Okay.
So I think those are kind of the two key items. There are other factors that will weigh in.
Yeah, and that's interesting though. Sorry, go ahead.
Those are the two kind of, when we look at it, usually those are the two first things that I look at, and then kind of respond.
Yeah, and I would agree on that. And then just to follow on also on the stapled policy, I think that's interesting that because we have seen that where actually the seller will fully negotiate a policy with the insurer and then say, and put it into the data room and say, if you want to buy this company, you have to use this policy. It's already done. It's negotiated. And that's something I think we've actually tried to do that with the U.S. buyer. And as you can imagine, that didn't go over very well.
In a quick auction, it makes sense, Peter. Like in a quick auction, I've seen different ways. Some people, I guess, call it like a soft staple, where they have a policy. You can use your own if you want, but at least it's sort of out there and baked in. Or more of this hard staple, like we're talking about, that they insist that you use it. But I think it flows from the difference in Europe, where in Europe they often will do a lot of the diligence on the sell side, right? So they will do a lot of your work for you, where we just are not used to doing that. So when you come into a European deal, a lot of times they'll have a vendor, diligence reports and a Q of E and all of this stuff. And so you're expected to just kind of do only confirmatory diligence kind of on top of that. And so it makes sense that they've worked with the insurer to kind of use those reports as part of it. Whereas on the US, we just are completely kind of reverse, right? And the buyer commissions the diligence reports that the insurer then uses. I think almost exclusively. Is that right? Or would the insurers also sometimes, would they use a seller vendor report in the US, or will they want your advisors to do the reports, buyer's advisors?
I think they want their cake and eating it too, usually. So they'll want you to do it, but then they're also going to want a copy of the seller report. I think, because we have convergence now and a lot of the US insurers have European counterparts, they're more and more willing to say, okay, there's a lot of diligence on the sell side. We're going to accept that you're going to be doing more of a confirmatory top up on the buy side. If that were to occur, I think there probably are insurers who would be willing to take a more European approach, even in a U.S. deal, if that were to occur. I just think it's pretty rare right now in the U.S. to have a lot of vendor diligence in transactions.
Yeah, it is. I've thought about doing that before in auction settings, representing the seller, and have occasionally done it, but it's just a completely different. It really is the point that we all talked about, just so it doesn't, go past everyone. That biggest difference is sort of the incorporating the diligence reports and the data room, right, into what is quote unquote known. So that in Europe, I think, right, they basically say everything that we put in the data room that qualifies the warranties in that, using their nomenclature. So and that, for buyers who are not used to doing deals, to me is one of the biggest differences. It obviously puts a lot of burden on what's in there and looking at it. In the US, the insurers don't do that, right? They don't incorporate just verbatim all the reports, and certainly not the data room, but it's very specific to what the seller discloses on their reps, or specific exclusions, right, that the insurers pull out of the reports. They'll read those, and if they see things they don't like, right? Is that how that works here in the US?
No, you're absolutely right. And I think that's actually a point that I sometimes, when talking to folks in the US, there is a misconception in particular, because the reps insurance policy does have what's known as the actual knowledge exclusion, which you can think of as the burning building exclusion, right? You can't put fire insurance on a burning building, and you can't actually know of a breach, buy a policy, and then recover for that breach. But I think sometimes you'll talk to folks in the U.S. who think that actual knowledge exclusion would apply to anything that's in a diligence report, and I think that's just not true. So that's a common misconception. So I think it's a good for you to make that point, and just to clarify that nothing in the diligence report in the U.S. is excluded. You have to actually have the buyer have an actual knowledge of a breach. So just a really simple example, right? The diligence report says there's a risk that the target is not a valid S corp. That S corp is not excluded under your policy in that situation by the actual knowledge exclusion. It is covered. If the insurer wants to exclude S corp status, they have to take an affirmative separate exclusion, which you'll be fully aware of, but it's not automatically excluded. On the other hand, if the diligence report says the target clearly is not in compliance with the S corp requirements and there's just no ambiguity, it's black and white, well then probably the actual knowledge exclusion would apply. But very rarely do diligence reports read like that.
Yeah, Jennifer, one thing I meant to ask you but never have, I think, these are insurance policies, and so are they, when there is a dispute, I'm guessing though, are they interpreted, construed with insurance policy kind of rules, as opposed to maybe contracts between sophisticated parties? And what I was thinking about is, are ambiguities or resolved against the insurer? I think that's usually a sort of a rule.
Yeah.
But is it kind of a mix between that?
Well, the general state insurance laws and common law can apply, but I think most, if not all, of these policies that I've seen have the language saying this is going to be treated as mutually drafted. Ambiguity is not construed against one party or the other. So they, because that is, you're right, and in other policies and other markets, that's the way that most insurance laws and the states have developed. But for this, I'm not willing to say that we absolutely couldn't argue that. But that's generally what we do in these policies.
And how do you
it's
think
pretty
about
hard to say
then?
this is a contract of adhesion, right? It's hard to argue it's a contract of adhesion if we can rewrite every word of the policy.
Yeah, it's much more.
I think what's interesting is the Novolex decision in New York came out, and the policy there being interpreted actually had a provision saying this is not a contract of adhesion. It's negotiated by a competent counsel on both sides. Yet, the court, and at least it's a state court in New York, just applied contra preferendum anyway. So, it's sort of an example of how strong insurance law is, and insurance law is notorious for being very
that's what
friendly.
I meant. Yeah, that at least that's at least that's something to look at. That this is fundamentally an insurance policy, so it's not exactly the same as negotiating an M&A contract. There is an insurer, and there's a lot of history, right, about insurers and what their coverage obligations are. And can you also make like bad faith claims, Jennifer, and other sorts of things like that? Is it the same sort of thing with insurance company that you might see in other coverage areas?
Yes. Yeah, no, absolutely. Now, I should preface this where that there has not been significant litigation over these policies or even arbitration. The parties tend to work together to try to resolve these claims or go to mediation. But there can absolutely be these bad faith or kind of extra contractual type claims, depending on the jurisdiction, of course, and what's allowed under those laws.
Yeah, and how do you both think about claims? Then I know that was one of the things we've kind of touched on periodically. What are kind of your best tips, Jennifer, and then Peter, on what if after closing you run into some of these issues? I think usually a lot of them come around financial statements or customer contracts. There's sort of those key areas that you tend to see claims developing. But how do you think about claims to try to make it as cooperative process, as effective process? But any tips for people that may be preparing for a claim?
Yeah, I think absolutely you want to. We work with clients all the time on evaluating whether a claim exists, and then thinking through how we want to notice the claim, whether we want to involve consultants, which consultants will we want to involve, and just planning, not taking for granted that the coverage is going to be there. You really want to think through claim presentation and proof of loss. I think it is important. The other thing that we sometimes get asked is, well, we don't know whether this is going to erode the retention or not. If you look at it this way, it could be a big claim. I think you need to notice all claims, and seek counsel and think through all claims like they're a big claim, and be prepared to give notice and follow through with the insurer.
Yeah, and I guess I can't resist going back to the comment David made earlier about what his ideal position would be to have an escrow from the seller, because obviously I'm a cheerleader for RWI, so I have to fight back on that one. I would disagree, and I've just seen, you know, I've been in the office with private equity client who was virtually in tears over extended litigation that had gone on for years with a fraudulent seller, right? And that's just not something you ever have in RWI, right? So again, this RWI, the concept is making a claim is not adversarial. I'm not saying you can't ever have a claim dispute, but the process of making a claim is not in itself adversarial. And so getting really good outcome on these claims, anecdotally, the claims I've had have been very positive, between like 3-month claim recoveries in, you know, fully compensating the client for losses they've incurred, including on multiplied damages bases. It's been a really, really good story for claims, particularly when compared with what you might get with a angry or emotional seller who's upset that you know, for example, I just built this business over 20 years and you bought it for me and now you're calling me a liar. Well, we're going to war. We're going to litigate. And there really hasn't been a lot of litigation. I mean, the other thing is the insurers view this as a long-term relationship. So bad claims behavior is detrimental to their ability to have a long-term relationship with the market. And we have not seen very many examples. I think, you know, right when I was starting out, there was an insurer who no longer does business and who came out of the market, who behaved badly on claims. I think everybody understands that if you don't behave on claims, you won't be able to sell policies going forward and be a part of the market.
Yeah. Well, I think it's a mix. I mean, right, it depends on the circumstances. I think the key for me is not that you don't use RWI. RWI is here to stay. There's no question about that. It's in recognizing where there's strengths and where there's weaknesses. And to me, as a buyer, the best approach is to have it combined, where you've built in your negotiating strategy and you have the capacity to have a mix, so that you're getting some coverage for excluded claims. Maybe you're getting some excess coverage beyond. An example you said, though, Peter, I'm not sure how that the RWI would necessarily solve it. If you have a significant fraud claim, for example, well, that's fine, but the coverage at RWI typically that people are placing is quite low. You know, you might have 10% or something of the deal value. So if you really have a significant fraudulent seller, sorry, but RWI is not going to help you. That's going to get you that portion back, but then you're going to have that unfortunate fight where you try to claw back, rescind the agreement, you know, go outside of the limitations in the indemnity and attempt to, you know, recover. And those fights, of course, happen all the time. And you can read about them in Delaware and other places, and they can get pretty nasty. But if you've been defrauded, RWI is not going to make you whole in most cases. I mean, you just don't.
Well, yeah, no, and that's absolutely the most effective and strongest coverage limitation in the reps policy is its limit of liability, meaning the amount of coverage. They aren't going to pay more than you bought. So that's definitely true.
So, yeah, exactly. So for big losses, you'll have to go elsewhere. But okay, anyway, we could go on and on because this is like one of those fascinating things. Jennifer, what final, I guess, advice, suggestions do you have for people that are not like you, real experts at this, but, you know, are thinking about RWI? What tips do you have for them?
Yeah. So, well, first, I should mention that in South Carolina, we're not experts as attorneys. We're not allowed to be referred to as experts. So I just have to throw that in there. But I think you need to think through it as early as you can in the process, and not to forget about how to incorporate and how to think about the interplay of RWI in your deal document. These are not independent parts. These are things that have to work together, and you need them to perform holistically. So think about it early and think about the whole as a whole process in your M&A.
Oh, that's perfect, Jennifer. Thank you. Peter, any final thoughts?
Yeah, well, I just one thing I'd like to talk about just for a minute or two is just the incredible innovation. So RWI and regular private company deals, yes, but just so everyone is aware, we also can put it on public company deals. That's less common, but I think over the next 5 years we'll start to see it. There's no reason we can't get there. I mean, we also have it in GP-led secondaries, so where private equity firms are selling crown jewels into continuation funds. We're seeing a real movement in contingent policies, thinking about insurance policies specifically for specific indemnities, things that might be excluded under the reps policy and are known, but we're getting coverage for those. We're starting to see RWI even on debt investments, on just contracts, on let's say you're just really essentially buying IP. Could you put reps insurance on the reps on that transaction? So pure play real estate, where it's just a real estate deal. And so lots of also other interesting things. What if you only wanted to insure the risk of fraud? You only that the seller's committing fraud. That's all you're getting. Could you do that? So people are just constantly thinking, what are different applications? I think RWI, a victim of its own success almost in the first 9 years, just crushing it, more work than anyone can handle. Now, finally, for the first time, folks are slowing down because there's so many insurers and enough people that now the workflow is more manageable.
Yeah.
Well, where can this go next? And I think that's the really interesting, because it's been such a phenomenally successful product so far. Where else can it start to really have a great application, throughout the M&A world?
We'll have to do a part 2 because you touched on so many of those things. I posted actually recently about RWI in public deals, and I've been sort of fixated on that as to why we're not seeing that more and why buyers actually aren't insisting on that, because the losses are just as real and just as common. Just having a public target, in my mind, doesn't really mean anything. The same risks are there, the same chances of there being breaches of reps. So that's a different area. And actually, Evan, terrific M&A lawyer, commented. We'll respond to that one in the comments. I think Peter and Jennifer may have comments about that. But Evan, I know you've seen the same thing, and I'm sure Peter and Jennifer have. What's interesting is RWI has gone, as you said, Peter, into so many different areas, but also down into smaller deals. And you're seeing so much more of that where they're able to get coverages. I've even seen, Jennifer, right? We've talked to some folks that are doing almost like pre-packaged. You don't negotiate them as much, right? They're using AI, they're using other sorts of things to get RWI into these smaller deals. What is kind of the deal? Where are you guys seeing deals where more traditional? Is it still, are you at the 20 million enterprise value range or something like that?
Maybe 10 million, $10 million, sort of $3 million policy on a $10 million deal. We're seeing that,
right?
So
We're seeing more
the diligence requirements sort of skewed towards smaller deals. So, we're not expecting a $10 million company to have the same compliance as Google or IBM, right? So you have underwriters who are specialized and are able to do those deals and not have the same expectations as they would on a $1 billion acquisition.
Yeah, Jennifer, you saw the same, right? We've talked to some folks that are doing really specialized in that.
And the idea of doing if you're going to have some add-ons, doing a platform and add-ons and having a policy that can apply to some of those smaller deals in that type of structure. We're seeing that as well. So I agree. Part 2, it sounds like part 2 needs to be.
There's so many fun things. I can't believe I get so excited about it. It's a little bit embarrassing, Jennifer. I know you love insurance, so it may not be, but for me, this is great. Thanks for the questions. If there's others that you want to drop to Jennifer or to me or Peter, please do so. And of course, if there is some demand, we could do a part 2 on some of these other topics. You could just go on and on about this. So I appreciate, Peter, you joining. Jennifer, of course, always fun to have you come on. And thanks, everyone, for joining us. We'll see you next time.
Yeah, thank you so much.
Thanks.